Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and a subject always near and dear to my heart, real estate, stocks, and investing. I got my start as a real estate analyst so many years ago. I've owned my own rental properties, and no other asset class has created as much family wealth. And the best part is, with REIT stocks, you don't need a lot of money to start, and you don't have that hassle of managing your own properties. But there are more than 300 real estate investment trusts trading on the US exchanges alone. Beyond that, there are 12 different property types with widely different fundamentals and outlooks. Now, these are the year-to-date returns through the first 5 months, and you see REITs have done really well this year with an 18% return versus the stocks in the S&P 500 that are up just 7% in that same period. But then if you look at the returns from last year, you had some REIT stocks like industrials and data centers returning 12 and 21%, but also some real dogs like retail losing 25% and office space down 18%. So in this video, I want to show you how to find REIT stocks to buy and how to build a portfolio of different property types, a portfolio that would make any real estate mogul jealous. I'll then reveal the top 5 REIT stocks to watch in 4 different segments. I'll be starting here with the Reliable REITs collection of stocks on stockcard.io. It's a filtered group of REITs with higher dividend yields, free cash flow, and growth that we can use to narrow our list before researching down to the top 5. I'll leave a link to StockCard in the video description below to check that out. And as a special bonus, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code BOWTIENATION, that's all one word and lowercase, for an exclusive discount beyond the free trial. Now let's get started, but first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Our first REIT stock is probably in my favorite property type right now. $1.2 billion medical facilities REIT, Community Healthcare Trust, ticker CHCT. This REIT owns 147 properties in 33 states and has 182 tenants across that healthcare space. And you can see here, it's got great diversification across facility types, from medical offices to clinics and specialty. As of the last quarter, occupancy is at 89.1%, which is a little low, but I'd expect that to increase later this year. And those of you in the nation know healthcare facilities is a theme that I've been watching since late last year. And during the pandemic, all medical providers had to triage their services, basically cutting everything that wasn't essential so they could help those COVID patients. Well, that meant a lot of times cutting all those elective procedures and the visits that often are the highest profit margin for the industry. But the idea here is that as these services start coming back, that's going to be a boom in revenue and profitability, first for these healthcare companies, and then for the companies like Community Healthcare Trust that own the properties. And actually, we're already starting to see that. The Wall Street Journal is out with a piece last week highlighting the trend and some of the companies in that space. For example, HCA Healthcare is up 25%, and Tenet Healthcare is up 72% just in the first 6 months of the year. Shares of Community Healthcare pay a 3.6% dividend yield, and the company has increased that every quarter since its IPO in 2015. Now, funds from operations, that FFO number grew by 23% in the first quarter and are over $45 million over the last year. And that puts it at about $1.92 per share, so the company is paying out roughly 90% of its FFO to cover the dividend. Now, that's a little bit on the high side, but nothing to be worried about, especially with that kind of FFO growth. Analysts have an average target of $54.11 per share, which is about 13.2% above the current price. Add in that dividend, and you're looking at a 16.8% expected total return over the next year and a great long-term stock. Now, we've still got 4 more REIT stocks to highlight, but I wanted to share the criteria in that Reliable REIT screener to give you an idea of how I started the search. The screener starts by filtering REITs for a dividend yield above 1%, which most real estate stocks are going to be able to satisfy that. REITs get a special tax break if they distribute at least 90% of their income as dividends to investors, so most are going to pay a very strong yield. It also screens for stocks with positive cash flow, which is important for any investment, but especially for these REITs where that cash flow is critical in keeping up that dividend. And finally here, it also filtered for stocks with a positive dividend per share growth rate, so growing that dividend payment over time, which is actually a pretty high bar considering a lot of these companies were forced to cut or pause their payments last year. But then beyond that initial list of REIT stocks, I wanted to make sure that I found stocks in different property segments to give the portfolio more diversification. I looked at funds from operations and the coverage of the dividend on that as well. I wanted to include a data center stock in the list with CoreSite Realty, ticker COR, and its 4.6 million square feet across 25 data centers in 8 US markets. Now, CoreSite is actually relatively small, even with over 1,300 customers, so I think there's a lot of growth potential, not only in that data center segment, which is one of the fastest growing property types, but also as the company grows into that industry. Shares pay a 3.9% dividend yield with 11% annualized dividend growth over the last 4 years. Now, management has guided to FFO of $5.50 a share, which means the company is paying out 92% of that funds from operations to cover the dividends right now. That is kind of high, so it's hard to imagine seeing much more than that 10% annualized dividend growth, but that's still very strong. The average analyst target here of $130 a share is right where the stock is trading now, but the shares have produced a 13.5% annualized total return over the past 5 years. But again, this is a very strong growth market, so maybe watch for a pullback in the shares, but I think long-term investors can like it here as well. Next is another REIT stock in the healthcare space, one of my favorites, Medical Properties Trust, ticker MPW. MPW owns more than 390 hospitals, long-term care facilities, and other medical assets in 9 countries. At $17 billion in assets, it's the second largest owner of hospital beds in the United States, with 67% of revenue from the States, 26% from Europe, and another 5% from Australia. And this is a very well-diversified portfolio of assets. You see here in this chart on the left by asset type. Maybe a little heavy in that general acute care at 80% of assets, but very little of the senior care facilities that have hurt a lot of medical REITs over the past several years. And I love the business model for this company. It uses a sale-leaseback strategy for acquisitions, which means it buys those medical properties from the healthcare companies and then leases the property back to them. And servicers like this because it frees them up to do what they do best and focus on that healthcare. MPW can then focus on what it does best, the real estate management. So this is decades of potential growth as the company takes advantage of the ultra low interest rates right now to consolidate all the medical properties out there. Now, this is a chart of the asset growth and really what you want to see with a REIT. Constantly growing that asset base of properties for scale and diversification. And MPW has done a solid job here, growing its assets by 30% annualized over the last decade. The company then puts these leases on triple net terms, which means the tenant bears all the property costs. And these are long-term leases also, up to 20 years, and 97% of them have inflation-based rent escalators, so they go up with inflation. Now basically, with interest rates where they are right now, the company can borrow at next to nothing, buy a property, and then immediately lease it for up to 20 years with no property-related expenses, and basically just swim in that free cash flow. Medical Properties Trust announced its 8th consecutive year of higher dividends. The annual dividend of $580 million is just 80% of the funds from operations, and we've already seen how this cash flow is super stable. The balance sheet here is fairly clean as well, with no debt maturities next year, and total debt is really spread out, other than about $3 billion to refinance in 2024 and 2025. Now, I'd expect management to be looking to take advantage of some of the really low rates right now and refinance a lot of that further out, which could also free up a lot of cash flow. On the valuation side, at a price of 14.5 times that FFO multiple, it comes in just under the average 18 times multiple for REITs in general, but right around the average for medical properties. Now, analysts have an average target of $20.27 per share over the next year, but I think this can go easily back up to that high of $24 each for a 17% return plus the dividend yield. This next real estate stock is a really popular one. Cell tower leader American Tower Corporation, ticker AMT. AMT is easily the leader in the space with over 187,000 sites in nearly every corner of the world. It owns the tower structure and the land, then leases out usage of the antenna and other equipment to tenants, usually cell phone carriers. And now you might think the cell tower business should be slowing down after decades of building, but the company is seeing new growth not only geographically, but also in new businesses as well. Connected devices are expected to grow 18% annually in the US alone as that Internet of Things, the IoT theme ramps up, and data growth internationally is even faster. The company booked 15% annual growth in its adjusted FFO, the graph here on the lower left, and I think it keeps that pace up with that IoT theme, data demands from streaming, and even that legacy mobile demand growth in emerging markets. Now, that strong growth has enabled AMT to increase its dividend by 18% over the last 5 years. Really an amazing payout growth that you just don't see with a lot of REIT stocks. Adjusted FFO of $8.35 per share means it's only paying 60% of that to cover the dividend, so it should have no problem growing the company in the future and that payout. The average analyst price target of $278 per share is only about 5% from the current price, but I think that dividend growth rate and the potential for more keeps the shares growing well beyond that. And everyone out there in the Bowtie Nation is going to recognize this next REIT, Stag Industrial, ticker STAG. Stag is another one of my favorites. The company owns 450 buildings in 38 states and 91 million rentable square feet in that industrial warehouse property type. The rise of e-commerce and online shopping has destroyed the retail property market, especially last year, but all those online orders need to be stored somewhere, and that means a boom in that warehouse demand. In fact, 43% of Stag's property portfolio is involved in some part of that e-commerce activity. No tenant accounts for more than 2% of the company's total rent revenue, so the odds of a tenant failure vacating lots of spaces is pretty much zero. Shares trade for just 18 times funds from operations, which is slightly lower than the industry average, but not quite the value play it was last year. The Stag does pay, though, a 3.8% dividend yield, and even better, that's on a monthly basis, so you know you're going to be getting that dividend check every single month. The dividend has only increased by about 0.8% a year over the past 5 years, so not huge growth, but the stock has produced a 14% annual total return, so a strong price return as well as yield. Now again here, the average analyst target price of $38 a share is right around that current price, but it's tough arguing with that long-term return. And I think this is a property type that's going to keep on rewarding investors for a very long time. Click on the video to the right for the top 5 safest monthly dividend stocks you can buy. 5 stocks for that stable monthly cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.